Okay, here goes. Hey everyone, this is Englandia. I'm sure you know me, head of ecosystem growth with Sovereign. I'm here to introduce the zero governance call number 7, I believe. Professor One Digit, he's our in-house scholar and data guy. He's going to lead the call, and please take the stage, Mr. One Digit.
All right. So is everybody able to see this dashboard?
Yep.
All right. So let me just start off with a little summary of where we are on things. So generally, starting with looking at zero, we have an origination fee of 5% now, and a minimum of 5%, and a minimum redemption fee of 1%. We've been trying to get the redemption fee back a little lower, um, to which would help us bring the peg up closer to 100%. And so that's been in place for the last week or two. Um, and then I want to show you some things going on with the sovereign dollar. Um, First of all, I have two plots here that show the dollar peg, sovereign dollar peg, relative to other uh, stable coins. And these are calculated by looking at the trading price of these different stable coins relative to RBTC on the platform. And so you can see that we've had interesting experiences with this. The Some of this, like for example, way back here, all the stable coins were trading a little low relative to the actual price, and this is and then it was corrected somewhat as redemptions kind of dried up here in March, um, and then it has kind of fallen again. And what's particularly interesting is there's been a divergence of the different stable coins compared to one another, and fairly low here for dollar price um, in DOC, which seems to have been the one that's been the most stable, as well as RUSDT. Um, and so and some of this could be explained by the redemption fee being fairly high. We expected that the gap would narrow. That is, that these would go up closer to 1 as we reduce the redemption fee, and it hasn't done that dramatically. Um, Theoretically, if all the arbitrage is being taken out of the system and there's nothing else going on that would create price imbalances, you would expect the peg to be at about 1% below 100% due to the 1% redemption cost um, to enforce that. But it hasn't really been that way. But in the last 24 hours, we see it has moved up closer to that range. And in fact, some kind of odd things have happened with like the dollar price in XUSD going above 1, which is some of this can be explained just by trading a lack of liquidity on in the different pools. And so if somebody makes a big trade in one pool, it will cause the price of RBTC to move out of line with the other prices. So some of this kind of temporary stuff is what's going on there. But anyway, that kind of gives us an overview of where we are. We'd like to be close to 1 if possible, and maybe now that this has come up some, maybe it'll stay closer to 1. Going back to zero, a couple of things to note are that our total supply of ZUSD has been going down, which is not surprising given that we have a very high origination fee right now, and redemptions have continued to happen some. But I wanted you to see something that I've added to the dashboard recently, and that is this breaks down the cumulative supply factors by different factors. So we've got 4 different things that can affect the total supply: the amount that's been borrowed, the amount that's been repaid, the amount that's been liquidated, and the amount that's been redeemed. So this black line here is the net. This is the net supply. This is the cumulative amount that's been borrowed, and basically the amount repaid is this orange amount as a negative amount. That's taken down that far. The amount that's been liquidated is the green amount as a negative amount, and then the amount that's been redeemed is the purple amount as a negative amount, which brings us down to this black line here. So that gives us a little better idea of what's going on. I think it's probably healthier to see that a good bit of this drop in the cumulative borrowed has been due to repaying rather than redemption, because that's the decision of the individual taking out the loan rather than somebody else imposing that on them. Another way to look at the same information here is the rate at which borrowing is happening versus redemptions and repaying. You can see that liquidation is basically zero because over here there's just not much happening. And the repaying rate right now is pretty low. And so you can also see that the redemption rate as a negative rate is a little bit bigger than the borrow rate. And so that's the biggest reason why the total supply is falling right now, is because the rate at which redemptions are occurring is higher than the rate at which borrowing is happening. Anyway, that gives us a little bit more insight into that aspect of things. And then one other thing that I think it's important to look at is how much much funds we have in the stability pool. And this has been kind of erratic as individuals make decisions about moving money in and out of there. But particularly in the last few weeks, we have added rewards, 5% SOV rewards to the stability pool, hoping that would attract some liquidity from outside of Rootstock.
She's doing what Fineline does, designer related things and kind of.
So this has actually gone down in the face of these 5% rewards, which is not what we wanted to see so far. It may just be that we haven't gotten the word out enough, but what we would like to do is see people bringing liquidity in from outside of Rootstock, particularly if they would bridge in stable coins from the outside, which would give others the liquidity they need to bridge out, and that would tend to correct the peg issues that we're seeing. But so far that hasn't happened. We've made some pretty strong efforts at publicizing this through blog posts, Twitter accounts, and Twitter posts and so forth, but it just hasn't caught on yet. So we're still looking for other ways to do that. But that's kind of generally where we are right now. So anybody have any questions or comments? Well, it's definitely not liquidations because hardly anything. We've had a couple of really small ones in the last few months, but nothing that would really uh, be very noticeable on that plot. So this is people just moving their money out of there when it goes down. There's no other uh, significant explanation for it than that. And why they're doing it, I don't know. And maybe it's because there aren't liquidations happening, and also because if you look at the potential for liquidation, it's pretty low right now because um, hold on a second. It's pretty low because if you look at right here, the potential liquidation total versus price, there's zero chance of a liquidation right now until we get down to uh, 15, a little over 15,000, because everyone's collateral ratio is so high. We have one line of credit here that's uh, below 200%. So that would be the most likely at this point. There's nothing that rules out the possibility of someone coming in and saying, "I want to put in a line of credit with 120% collateral ratio tomorrow," and then there's a pullback in the price that causes them to be liquidated. So this can change. It can change overnight easily if somebody puts in a low collateral ratio line of credit. But that's where things are right now, and it doesn't look particularly promising at the moment. So the liquidation component of the stability pool doesn't look particularly attractive, although it's very hard to predict. Uh, but on the other hand, we do have this guaranteed 5% now, and especially if you've just got money sitting around in a stable coin, being able to earn 5% on it's a pretty good deal. So I think we need to get the word out on that, and also the situation with liquidations can change very quickly. That's about all I know to say about it.
A question. I was trying to figure out where does the yield come from for the UST and the USTD tether, and also for the other stable coins that are participating in the lending pool.
Okay, you mean like if you're lending your stable coins through the lending protocol? Is that what you're talking about?
That's correct.
So that comes
I guess
about.
what my real question is like, why is it that the dollar, the yield on the dollar from the lending pool is so low, yet for USDT, Tether, and for XUSD, we have such a much higher yield. And
Right.
dollar, there is no demand to put, dollars into the lending pool.
Sure. Well, the use for that is if anyone wants to make margin trades on our platform, then they have to borrow if they want to use sovereign dollar or USDT to set up a margin trade. Then implicitly or behind the scenes, the margin trading borrows that particular asset and uses that to buy more of whatever other asset you're putting in that margin trade with, RBTC or whatever. So when you do that, when you put on create a margin position, you are actually paying some interest for the extra control that you have over those extra assets, because you're actually borrowing some of that stable coin in order to make that trade for you. Does that make sense?
Yes, it does. But then my next question would be is then why do we do not have a dollar trading pair in the margin trading? And why aren't we using dollar for that so that we could create a better, higher yield in the lending pool for dollars to attract some liquidity over to that lending pool?
Right, absolutely. I think the intention is to do that. I think in order to bootstrap the margin, the pool, in order to have the ability to do margin trading, we needed to grow that pool a little bit first. And so that's part of it. And there may be a bit of a development effort on that as well. But that's definitely, I think, part of our intention to do that. And
enabling margin trading is being worked on right now.
Okay, great.
Could you
So
repeat that?
your answer to that question, one digit, was correct. There was a kind of staged rollout that was required. First was opening the dollar AMM pool to build trading liquidity, and then opening the lending pool to build up lending liquidity. And now with both of those pools in place and some liquidity provisioned, we can turn on margin trading. So the developers are actively working on that right now, and it should be done within the next week or two, maybe even sooner.
Okay. One of the things that I want to do, I want to kind of preference, my comments here, suggesting that I'm focusing on things that I feel like are not necessarily working. I believe the team and the developer, you guys are doing a great job, but I do feel like we kind of lost our way on some of the things when it comes with respect to the zero protocol. I guess, this whole idea of redemptions, to me, I think we lost our way when we got to the idea that anybody's Bitcoin can be redeemed. I mean, the whole idea I thought was to borrow against your collateral. And it seems in my mind that the only person that should be able to redeem your collateral is you. Now, we started out with the idea like the only way you would lose your Bitcoin is if you were liquidated. And then it became this thing where anybody could redeem your Bitcoin, which to me is kind of like a bait and switch, because that wasn't the original concept or idea. So I guess my next question would be is like, why aren't we allowing redemption of dollars against like maybe the AMM pool where we have some liquidity for Bitcoin and dollars, as opposed to allowing us to go in and just randomly redeem against anybody who has taken out a zero loan?
Well, first of all, the redemption mechanism was built into the protocol from the beginning, and it was in the documentation from the beginning. It wasn't being experienced much early on, so it didn't get a lot of attention, but it's been there the whole time. It was part of the explanation about about how this works. And honestly, without the redemption mechanism, it will not. There's no way to have a portable stablecoin asset, because if you borrow against it and you create or mint stablecoins as a result of your borrowing, and then you do something with those stablecoins, the person who receives the stablecoins wants a guarantee that he's going to be able to swap that stablecoin back for $1 worth of Bitcoin. So the only way that guarantee can happen is if someone else other than the person who borrowed can trade that in for $1 worth of Bitcoin. That's the idea behind the redemption mechanism. It'd be pretty similar to, say, a bank issuing gold certificates, and you take a gold certificate and then you take that gold certificate and you buy something with it. The guy that receives the gold certificate needs to be able to go to the bank and get get the gold that the certificate represents, or else it's not worth anything to him. So that's the idea behind it. That
Well,
can't be.
actually, to extend that metaphor, there's actually a fundamental trade-off here in the design space of a stable coin. And similar to the design space of paper currencies, previously we had these gold-backed certificates. The dollar was backed by gold and redeemable for gold, but eventually they removed the redemption mechanism, basically closed the window and rug pulled everybody who was holding dollars, so that now that you can't redeem dollars for gold anymore. And there's an interesting question to ask of, well, why didn't the dollar just immediately collapse to zero if it suddenly became completely unbacked? And there's kind of two answers to that question. One is related to the chartalist theory of money, where they basically use taxation as a way to remove dollars from the system and encourage people to keep holding dollars. But the other mechanism that the Fed has is interest rates. So they use interest rates to basically, they lower interest rates in order to kind of push the price of the dollar down, and they raise interest rates when they want to bring the price of the dollar back up. So this causes the kind of boom and bust cycles, inflation and deflation in the economy. And this is very similar to how a stable coin like MakerDAO works, where MakerDAO, they don't have a redemption mechanism per se. They have a stability fee, and the trade-off that they have made is that in order to keep their peg as close to 1 USD as possible, if the peg breaks to the downside, then they will raise interest rates, which creates demand for DAI, so that people can pay off their debt, so they're not paying off, so that they're not incurring these high interest rates. And if the peg breaks to the upside, then they lower interest rates, which increases borrowing, which puts downward pressure on the price, bringing the price back down to $1. But there's this constant interest rate, or stability fee, as they call it, which users have to pay on an ongoing basis to maintain their maker vaults. Zero and the liquidity protocol that Zero was forked from chose a different trade-off, which is that users do not have to pay an ongoing interest rate or stability fee to maintain a line of credit, but to support the price of ZUSD, or support the peg, if it drops to the downside, since we can't increase any interest rates, we have to have some sort of way for the protocol to support the price if the peg drops to the downside. And so the mechanism there is the redemption mechanism, where if the price of ZUSD drops below, or to a degree that brings it below the redemption rate, then it becomes profitable to redeem ZUSD for Bitcoin and basically arbitrage the price back up closer to $1. Like I said at the beginning of this explanation, this is a kind of fundamental trade-off in the design space. Either you are going to have this redemption mechanism, or you're going to have an interest rate. And for Zero, we chose to have the redemption mechanism rather than an interest rate. If you're a borrower and you don't want to have to worry about redemptions, you can use the sovereign lending protocol, which will you'll have to pay an interest rate, but there's no There's no redemptions on that protocol. So we have a choice for people who, you know, have, for both kinds of audiences, depending on what your risk tolerance is, or you know, generally how you want to manage your loan.
Okay, so if we're gonna say that redemptions are, you know, tied into the whole the protocol and the process, I guess I fail to understand why we don't have a liquidity pool specifically for redemptions to incentivize a pool, you know, whether it's through sovereign subsidies or whatever it is, for people to actually redeem their dollars for Bitcoin, as opposed to um, going after individuals collateral who have, you know, because I mean, my thoughts are that we'll have a lot of people, unless you're a power user, you have people you'll see on Telegram, they come in and they haven't been around for 6 months, 8 months, a year. You aren't going to have casual users if they got to constantly be watching and worrying if they're going to be redeemed. Is it at 200%? Is it at 300% now that I need to have the CR, you know, collateral ratio? And is that changing as opposed to just knowing that, hey, I could be liquidated if Bitcoin starts going down, you can say, okay, I need to check on and see if I'm gonna be liquidated or not. So I would say we won't get the casual users, and that's how we'll build the protocol. We're not going to build it from power users. At least that's my thoughts. That, you know, we won't get to the level that we would like to see. So again, I guess my question would be: is why are we issuing dollars if we don't have a pool to actually redeem our dollars for Bitcoin? We shouldn't be making more dollars than we actually have Bitcoin that can be redeemed against it. And if we get a pool, you know, used for redemptions, it seems like that would, you know, incentivize people to actually take out these loans, zero loans, knowing that, hey, I am the only one who's going to be redeeming against my Bitcoin. That makes sense at all? Or?
Yeah, I mean, it's the when I think we've talked about different ways that we could maybe create another pool of Bitcoin that the dollars would be redeemed against first before touching lines of credit. The main question is, you know, if you set up that pool, you're kind of just shifting the problem in the sense that once somebody comes along and they redeem their dollars for Bitcoin, now whoever put the Bitcoin in that pool is holding sovereign dollars. And what are they going to do with those sovereign dollars? You know, are they going to turn around and sell them on the market so that they can refresh the Bitcoin that they had in the pool? If they do that, then they're just putting more downward pressure on the sovereign dollar price because they're selling them on the market, which, you know, induces more redemptions. So it's the redemption mechanism as it currently works is a kind of clean, net neutral operation in terms of you know, the effect on the market, because it's canceling out debt. So you know, the sovereign dollar isn't just a hot potato that's getting passed from one person to another. It has a terminal endpoint when it gets basically burned and cancels out the debt on the line of credit that's being redeemed against. And then, you know, it actually has a positive price on the positive effect on the dollar price if the redeemer turns around and sells the Bitcoin that they've received for dollars, which, you know, again props the price up and gradually arbitrages the price back up to $1. But yeah, the most important aspect there is just that the dollar is no longer like a hot potato that's getting passed around. It just gets burned, and then it cancels out the debt. Whereas with the kind of mechanism that you're describing, the dollar is still kind of a hot potato. It's getting passed around. What are the people going to do with it? Ultimately, the way that you solve the redemptions problem is by creating demand for holding sovereign dollars, and not
So it's not.
just turning them around and dumping them on the market and depressing the price and incentivizing redemptions. So there are all kinds of use cases that we can imagine that people might want to hold sovereign dollars for. Maybe it's as a treasury asset for corporations, or maybe it's for savings, or for individuals, or maybe it's for like a safety net for individuals and businesses who don't want to have to worry about holding dollars in a bank account or fiat stable coins. We have the stability pool, we have the AMM pool, we have margin positions, the lending pool. There are all these kind of places where dollars can just sit, and where they're not getting dumped on the market, but the people are actually just holding them. And so it's a matter of like finding the people who have dollars or need dollars, and telling them that like the sovereign dollar is actually a very it's a very good dollar. It's fully backed by Bitcoin. It's much more censorship resistant than like the fiat stable coins, and so on and so forth. It's like much more like digital cash than it is like dollars in a bank account, and that has value. And so we just it's up to the community to now go out and find those people who share that value and need sovereign dollars.
It's not that I disagree with you. I mean, everything you're saying makes a ton of sense. But, and here's the big but, is how are you going to convince people to take out loans when they can be redeemed against, you have to keep a 200, 300% collateral ratio in order to not be redeemed against. And if we believe in this redemption so much that this is the mechanism in which we work, then why don't we allow everybody to redeem them? Why don't we just have a redemption button for everybody that we don't need to be a developer to redeem for our to redeem our dollars for Bitcoin? Why is it just for a select group of people
Those
who
are
have inside knowledge?
Yeah, those are great questions. And I wouldn't say it's like inside knowledge is the only people who can redeem, but certainly there's a technical barrier because you have to know how to interact directly with the smart contracts. On that particular point, we're looking to reintroduce a redemption feature to the front end, but in a way that only encourages using it for the specific intended purpose, which is arbitraging the price back up to $1 if the peg is breaking. So the implementation is such that on the convert page, where currently you can basically use the Mint protocol to convert DOC or ZUSD into sovereign dollars and vice versa, we are also introducing other, we call them conversion routes into the form there. So Mint will be one route where if you have assets that are supported by the Mint protocol, then your conversion might be routed through Mint. But your conversion, depending on the assets that you selected to convert between, the conversion could also be routed through the AMM, or it could be routed through Zero using the redemption mechanism. So, like if you have selected DLLR to RBTC as your conversion, and the redemption mechanism actually offers you the best price, better than the alternative routes, and the other alternative route in this case would be the AMM, then your conversion will get routed through the redemption mechanism, and you'll convert dollars to Bitcoin using the Zero redemption mechanism. But if the AMM gives you a better price, then your conversion will get routed through the AMM, and you'll basically, in the back end, be doing a swap for dollars to Bitcoin using the AMM. And we think that's the best way to reintroduce this feature into the front end, so that it is getting used when it's appropriate to, and not otherwise. So that's the conversion front end. There's more dollars than the market is able to absorb, and so this is depressing the price of the sovereign dollar and incentivizing redemptions. And like I said earlier, the only way to solve this problem, like to really systemically solve it without just kind of trying to paper over the problem, is by increasing demand for sovereign dollars. So I think if we can get a healthy demand generation going through marketing efforts, through business development, and other kinds of partnerships, through all of the different ways that we can find people who need digital dollars and want the most secure, strongest digital dollar, then we could start to see that trend reverse, and maybe even see sovereign dollars go above $1. And if we consistently see that happening, that's like a good problem to have. We can start to lower the origination fee rate and incentivize more borrowing, and eventually the cycle kind of starts going in the other direction. You have this kind of virtuous cycle of more demand pushes up the sovereign dollar price, which means that we can lower the origination rate, which brings in more borrowers, which brings more sovereign dollars onto the market, which brings the sovereign dollar price back closer down to $1. And we can get the seesaw going in kind of a positive direction. Right now, the kind of seesaw is going in a negative direction, in the sense that like the sovereign dollar supply is actually shrinking. But if we can get the demand generation kickstarted and going in a sustainable growth direction, then we could get it going up in a positive direction. And once those origination fee rates are able to start coming down again, I think that's just going to naturally encourage more borrowing, maybe from the riskier kind of side of the market, or the more risk tolerant side of the market first. But as the redemption rate starts to come down and people see that like redemptions are happening less and less, then I think it'll be more likely that we can convince people who are further along the risk curve, more risk averse, to say that borrowing is it's okay to borrow again. The risk of redemption has gone down because we have these sustainable demand generation mechanisms, and then for the most risk averse part of the market that like couldn't stomach any risk of redemptions, like I said, zero is probably not the right product for them. They should use the sovereign lending protocol instead. They'll have to pay an interest rate, but they don't have to worry about redemptions. It's
So
like I
as of
said,
right now,
yeah, go ahead.
so as of right now, the cost to swap is that much higher than the cost to redeem. I know the redemption is what, 1.5%, and the swap is what, 2.5 or something like that, or
It's 0.35% for the fee, but it's not just the fee. It's also, you also have to take into account the price that you're getting and the slippage. So yeah.
when you say the fee, you're talking about the redemption fee or the swap fee.
Well, I'm talking about altogether, like the rate that you are the rate that you are getting for the conversion. So like, and that takes into account the fee, the trading fee, as well as any slippage that might be incurred, and the overall like current market rate being offered. So on the zero redemption mechanism, you have to take into consideration what is the current BTC USD price that is being reported by the zero price feed, and what is the redemption rate, and then how much will the redemption rate change based on the size of your redemption, because the more ZUSD that or sovereign dollars that you're redeeming, the higher the redemption fee actually gets.
So you're basically saying we just don't know what the cost of those redemptions are to us not going in, that it can fluctuate and change as we're actually in the process. So we don't know whether swapping costs more or redemption costs more. We don't know. We don't have anything barometer to compare it by.
No, we do know. I'm just saying that like it's not enough to just look at the fee. You also have to look at the current market rate as well as any slippage that might be incurred. And we
I understand.
know what those
I
things
guess
are.
what
We
I'm
know
saying
what
in
those things
general,
are. They're mathematical formulas, and you can simulate
I,
the effects of
I,
transactions to see what's going to happen.
I understand that you know
Yeah.
what they are. What I'm saying is the users, somebody like me who comes in and I want to say, okay, I want to swap or I want to redeem. And I'm saying,
Hmm.
do I know which one is more cost effective for me?
Right. Right now that's the case. Like right now, the redemption mechanism, it was removed from the front end because it's intended to be used by expert users who understand how it works, understand the purpose of the mechanism, understand how to interact with it, understand when it's profitable, when to do it. And because the old interface just didn't really have that, like those guardrails in place. The new interface that we're working on, which brings redemptions back into the front end, does all of that comparison for you. So it automatically, we call it a smart router, is like the name of the software. The smart router does the comparison for you and says, right now it's going to be cheaper for you to go the redemption, or vice versa. Right now it's cheaper for you to go to the AMM, and it's going to automatically select that route for you based on whichever one gives you the best overall rate, incorporating the fee, the slippage tolerance, the current market rate being offered on either the redemption or the AMM, and whichever one is going to get you the most Bitcoin or the most dollars, or whatever asset you're trying to buy, that's the route that it's going to give you, so that you always get the best rate. You
Okay,
don't even
great.
need to compare.
Great.
It just automatically does it for you.
Great. So I guess, here again, I want to say, you guys, hey, I think you're doing a great job. And, I'm just trying to bring up some of the concerns or questions I had in my mind. And I guess, you know, I guess we're headed there. I guess I'm trying to get some concept or idea of when do we anticipate that we'll be there where we'll have margin trading, we'll have a trading pair for $1 on margin, when we'll have, this redemption set up where it'll be automatically determined for you which is the best route, whether to redeem or to swap or what have you. Because these are the types of things I think that will, help us to get where we're trying to get to with zero. And I'm sure you guys know that as well. I'm voicing them so that people like myself can also kind of understand what you guys are doing and the roadmap that you're on to try and get us where we're trying to go.
Yeah, no, these are great questions. They're the right questions to be asking. So we definitely appreciate you joining the call and voicing these questions. So to answer the questions about, you know, the development timeline, for those features that, you know, we've been discussing so far, the margin trading and the smart routing on the conversion page. Um, the margin trading, you know, I said earlier, we expect it to be done within a week or two. That range is just because it's currently in QA, and you know, the QA process could uncover implementation issues that need to get fixed. So there could be some back and forth, or it could be all a-okay, and you know, we get the sign off sooner rather than later. But so that's kind of the time frame for margin trading. On the smart routing on the conversion page, this should probably be done by the end of Q2, maybe even sooner. But yeah, so I think that would be like the end of the month.
Okay,
Yeah, because yeah, we're already in
great.
June. So
Great. I appreciate you guys. Yeah, I appreciate you guys um, enlightening me or informing me of what's going on. Thanks.
Well, the reduction of the redemption fee has not uh, closed the gap in the peg as much as I think any of us would have hoped that it would. Um, Although, like I said, right now it seems to be pretty close to where you would expect it to be. But there really is no other mechanism for doing that at this point. So I think what we've done so far is the right move. I think where we are is pretty good as far as the redemption. As far as the origination fee goes, this goes right back to this discussion we've been having, and that is that if you don't if you don't balance supply and demand, there's only one thing that can happen, and that is you depeg. The price is going to have to change. And so right now, we evidently have more supply than we have demand, because if you don't uh, change that, the price is going to go down, or you have to change the supply. And so what's happened is, because of redemptions, we're changing the supply by lowering the supply through the redemption process, and that's what protects the price. But the other way to tackle it is to not allow that much supply to begin with, and that's why we've kept the fee so high at 5%, is so that we're not minting so much sovereign dollar as we were before. So I think that needs to stay in place for now until we solve this problem of demand on the demand side. I think, one possibility would be just shut it off and not allow any borrowing at all. But I think that it makes sense just to have a high fee like this instead of making it impossible, because uh, there may be a few people who are willing to borrow this asset with a 5% fee, because they're looking at it long term. And long term, a 5% one time fee is still smaller than paying an annual interest rate, even a modest annual interest rate. And the second thing is that we can if the collateral ratio is an issue. Having to have a high collateral ratio is just to protect your line of credit from redemption. That's not the ideal situation. But one way you can look at this is it gives those people who are concerned about redemption an opportunity to basically buy insurance. And the way you buy insurance against redemption is you put in a lot of Bitcoin as collateral. So if you're willing to do that and you're willing to have a large amount of collateral for your loan, you can protect your loan that way. It does cost you something. It costs you something in terms of locked up Bitcoin, but any insurance costs like that as well. So I'm personally in favor of keeping that redemption. I mean that origination fee fairly high where it is right now. That opens the door for those people who have a very strong incentive to go ahead and do it, but at the same time, it keeps the supply from growing too rapidly. And I'm in favor of a small redemption fee period. So I'm good where it is right now. 5% origination fee, 1% redemption fee.
I have a question, one digit, which is, have you observed new borrowing activity, and do we know what those borrowers are, if there are any, are doing with their ZUSD or sovereign dollars?
I haven't tried to break it down to what individuals are doing, individual flows. This person borrowed, where did that money go? You can sort of look at it more aggregately, and aggregately we can see, for example, how much is going into the AMM, and we see up here that 78% of sovereign dollar is in the AMM. So that's a pretty high percentage. Over here on zero, you've got about 400K in the stability pool. And as I mentioned earlier, that's not growing as we might have expected it to, with the incentive of SOV rewards in there. So that's a separate question, but that's where some of it's going, is in the stability pool, but it's not increasing right now. And then this other thing, which you may have come in the call a little later, but were you there when I explained this?
I was here for all that.
Okay. So you can
yeah.
see
So
that.
the reason I ask is mainly because, like, if we do see that, even with the 5% origination fee, people are still borrowing, and then what they're doing is they're going and they're selling their dollars on the AMM, which is contributing to redemptions.
Right.
Then it would kind of indicate to us, like, if that's literally all people are doing when they're borrowing, then that's not really good for the system, and maybe we should just outright pause borrowing, or continue to increase the origination fee rate.
Right.
But without that empirical data, I don't think we could make a decision there. But I think that would be something that would be worth looking into, just so we have that data to help inform our decisions of what to do with the origination fee rate.
Sure. Here's one more piece of data here, and this is the cumulative dollar trading flow on the AMM. So, it would have started at zero, and interestingly enough, it's right back pretty close to zero. So the net amount of trading between Bitcoin and sovereign dollar over the history of the AMM is pretty close to zero.
In terms of buy and sell canceling each other out?
Yes, exactly.
Okay. Yeah, that is interesting. Okay, so it seems like closer to being in balance then.
Right.
That's good. Okay, then I think that would be enough information for me to say that I think I would agree with your assessment that maybe we hold, and I might even be okay with, like, maybe like a 0.25% or a 25 basis point decrease in the redemption fee rate, just so that we can continue to tighten up that peg. But no strong opinion there, really.
Yeah, I'm in the same boat. I wouldn't argue against dropping it to 0.75% either, if that's what people want to do.
To tell or decide, or is this something that we want to take a survey for? 1% versus 0.75%. I mean, do we have any other opinions here?
Doesn't sound like people are rushing to the mic.
Yeah, I mean, it seems like, in my opinion, too minor of a change to decide that, and part of me wants to wait another week or two before making a move like that. It just seems that only recently has the trading of dollar against Bitcoin been rather stabilized. So I'm in the camp of let's not vote yet. Yes, Light. I think that was what was in question.
Right, and I mean, one argument for that is a quarter of a percent is not that significant, and there is some effort required to do a SIP to make that change. And so, unless there's some compelling reason to make any change, maybe it's better just to leave it as is. Another point along those lines would be it might make more sense to wait to change the redemption fee at some point when we are also changing the origination fee, and we have some good reason to change that by more than 0.25%, and that's probably coming down the road soon. So I guess that would make sense to just leave it as it is, just because it's not worth the effort to change it.
Put a question in the chat for this channel. If you click the little chat icon on the community channel, you can see the question there with some thumbs up if you agree with the change, thumbs down if you disagree with the change. If you want to take a stance, you can answer that. Just kind of get a pulse check and see if it's worth writing up a SIP for it.
Yeah.
So far, it seems like mostly negative sentiment on that question, so we might stay in a holding pattern where we're at. Yep, that seems to be the consensus.
Yeah.
All right, thanks everyone.
Yeah, this was a great discussion, guys. Let's revisit this question in a couple of weeks when we have some more data. But yeah, I mean, I'm definitely in favor of, like, over the mid-term reducing the redemption fee and the origination fee as this platform matures, and let's also see how things function once the two application updates go live. I think that would be very interesting to see. So thanks a lot, One Digit, for leading. Thank you, T-Bone, for the questions. Thanks a lot, Light, for the clarity. And thank you to all you Sovryns for joining us in this very rich discussion. So stay sovereign, everybody. Have a good week. See you tomorrow at the community call at 3 p.m. UTC, 11 a.m. Be there with some questions. And thanks a lot. Over and out.